Federal Reserve raised its key interest rate to another 0.75 of a percentage point yesterday. We knew it was coming. It is the sixth rate hike this year and the fourth consecutive jump of 0.75 of a point since June. So this comes as the UK is set to announce its biggest rate hike in more than 30 years. Javier David is here with me in Studio 57 to talk a little bit more about this. He's the managing editor of business and markets at Axios. All right, let us get into it. So we teased earlier there's a drop in interest rates. I see more, the headlines say a dip.
Yes.
Because I know people are like, did I miss it? I got to run to my bank. So what happened with the interest rates dip? Like, what was the dip and what happened?
Basically, interest rates have been so high that people are not applying for mortgages. So what that does is create a little bit of fluctuation in demand. So yesterday we had some data that showed that the mortgage rate dipped. And I say dipped because it's not a meaningful enough drop enough for people to be like, okay, this is it. This is my chance. I
said a red headline that said below 7%.
Yeah, so it's about 7%.
It's about 7%.
What I have, according to my data, is 7.06%. And that's down about 0.1% from a week earlier. That's not really meaningful
That's
enough.
nothing.
Yeah.
All right. So let's get into the announcement. The federal chair warned that things were going to get worse. He said, I wish it didn't have to be painful, but it's probably going to be painful moving forward. Are there any sort of industries or indicators that the Fed looks to determine that they've gone far enough? You know, we know it's going to take time for us to feel this. And the Fed doesn't want to go too far. What do they look at to be like, all right, we'll stop here and wait for things to take effect?
Their primary focus is on inflation data and the jobs market. And they're looking at wages. They're looking at what consumers are paying on a day-to-day basis. There's certain GDP deflator. There are certain indicators about that sort of are metrics for inflation. So that's really what they're looking at. It's what they really want to see. They really want to see a meaningful pullback. Their target rate is 2%. We're running well above 8% in terms of consumer prices. And the jobs market is key. We've got jobs data tomorrow. They want to see a meaningful pullback in the amount of jobs that are being created. This week, we had data that showed that the number of open jobs unexpectedly jumped again. This market is as stubbornly strong as it has ever been. And it is running counter to what the Fed needs to see in order to say, okay, enough is enough. And so monetary policy is a weird thing because it operates on a lag. So you can hike rates tomorrow and you may not see the effects for another 3 to 6 months, maybe. So now they're at the point where they're saying, okay, we can calibrate things based on what we're seeing in the economy. So if the economy is showing real signs of weakness, we can not pull back, but maybe we can do 50 basis points as opposed to 75 basis points. So this is what they're trying to figure out now. But the chairman made it very clear that the job's not done, and we still have a long ways to go before they are done.
So this seems to me, a novice that knows nothing about this, really aggressive. I wonder if there are any dissenting voices out there that are saying, smart people who watch this stuff, that are saying, I would do it differently.
Well, there's a brewing political debate. There are two key things that any central bank is charged with managing. The first is price stability. And now price stability has gotten so far ahead of them, they're kind of front-loading, as we say in sort of market parlance. They're trying to catch up. So this is why the cycle has been so aggressive. That and full employment. And a number of voices within the Congress, not within the Federal Reserve, but have said, okay, you guys are affecting employment. We don't want people being thrown out of their jobs because of this. You really need to consider your other mandate, which is, do people have enough jobs? Are there enough jobs to go around? And right now, there's way more than jobs to go around than the Fed is comfortable with. In fact, it's like still 2 jobs open for every 1 person that wants one.
So, and I had asked you earlier about what sort of indicators they look for, and you sort of listed a bunch of indicators, but I wondered if there were sectors that can drive inflation or bring it down. I was thinking the housing sector.
Yeah, well,
if they see the housing sector slow down, then they think, oh, there are all these other jobs connected to the housing sector. In 6 months, people could lose their jobs, so let's
stop.
Yeah.
And the funny thing is, residential investment or housing sector is a big chunk of GDP. So the slowdown in housing is really a drag on growth. And at some point, you're going to look at this and say, we've had so much retrenchment in the housing sector, that it's becoming a real negative for growth. It may yank us into recession because the activity in mortgages and housing is so bad right now.
Really, really quickly, we know the Fed chair has told us about this anyways. He said there were going to be more hikes before the end of the year. Has he said anything to indicate what's coming up next year?
Well, not yet, and that's the really big question, because if growth is slowing and it looks like we are either in recession or heading toward one, they're going to have to start thinking about whether or not they need to ease. Now, they have given zero indication of that they're even remotely prepared to do that. Right now, it's all about beating inflation. It's all about getting it back towards 2%, that magic number. We can't even discuss an easing at this point, but it may have to happen.
Javier David, always nice having you, sir.
With the good news.
Yes.
Sorry.